Good morning. Today we are with sources of finance chapter that is to be included in BCom second year financial management. This is the topic of financial management book that is sources of finance. And when we talk about finance, that means to run a business, we need finance because it is lifeblood of a business. So we should know that from where we can arrange finance, because as for any of the organization, finance is the important part, and various sources to get my business upgraded. I should know the sources from where I can arrange money for my business to run its working smoothly. So today we'll be discussing for the sources of finance what we have. So as I have already told you that finance is the lifeblood of the business, and so no business can run anything without the finance. So we should know the various sources from where we can arrange finances. The sources can be external, can be internal, can be long term, can be short term, can be fixed, and the working capital finance. So in this particular video, we'll be learning about external, long-term, short-term, fixed, and working capital finance, that how to get arranged. Traditional sources of finance were security financing, internal financing, and loan financing. One by one, we'll be discussing upon all these three matters, that what is security financing, what is internal financing, and what is loan financing. In security financing, when we are talking, that means we are talking about the finances which can be generated with the help of equity shares. We can arrange finances from preference shares. We can arrange finances from debentures and by the public deposits. So these four resources, traditionally we were talking about this, and these were the four resources from where we can finance for a company. Then when we move for internal financing, in that we will be learning about retained earning. We'll be talking about depreciation fund. And thirdly, as per the traditional source of finance, we will be going to loan financing, that rather short-term finances we can arrange or long-term finances we can arrange. So we'll be moving with long-term financing, that is meaning and purpose of long-term finance. That is, it's a form of financing that is provided for a period of more than a year. If we are talking about short-term period, that means we are talking about less than 1 year. And long-term finance means that we are going to take finances for above than 1 year. That means for 2 years, 3 years, 5 years. So that will be considered as long-term financing. Long-term finance is also known as fixed capital finance. So these are the purposes why we go for long-term finances. That is to finance for fixed assets like land, building, furniture. These are our fixed assets. And if we want to have finance of these, so we need to go with the long-term finances. Then expansion of a company. If I want to expand my company, I want to horizon of my company to be explored, to be expanded. So for that purposes, we definitely need long-term finance, because if we'll be taking for short-term finance, that within a 1 year, if I need to return the money, then it will be of no use, because spending so much need some time to be recovered. So expansion of a company need long-term finances, so that whenever we are taking finances from a company, so we should get a plenty of time to return that particular finances. Then increasing the facility of my business. For the construction of the projects on the large scale, we need long-term finances, and for definitely for acquisition of my companies, we need long-term finance. Then that means when long-term finances are being taught, then we'll be going with the security financing, that is shares, that equity shareholders, from equity shareholders we can generate money as they become the real owners of the company, and they remain associated with your company for dividends, and they become your long-term finance holder or long-term that resources can be generated from equity shares, that finances can be generated from preference shares, and in this various types of equity shares like convertible, non-convertible, redeemable, irredeemable, all kind of equity shares can be treated. Then preference share the same way, that fixed percentage that we are giving as a dividend to the person, fixed dividend is being given, and the payment takes that priority over the ordinary share dividends. So we have to consider this, that whether we will be going for the finances from preference shareholders or not. Then we'll be moving with the debentures. It is a debenture is a kind of debt instrument issued by a company that is not secured by the physical assets or collateral. For these kind of that, if we are going for the debenture holders kind of financing, we need not to secure any kind of fixed asset of my company, nor any collateral security is required. Then if we'll be going with public deposits, we can generate funds or finances from here. It implies any money received by a company through the deposits or loans that is collected from the public. So this is all what we consider for the security financing, right? Then when we are talking about internal financing, that means some retained earnings. Retained earnings are uh, profits of your company, or that has not been distributed among the shareholders. So whatever your company is earning as a form of profit, you are not distributing the whole of the amount to the shareholders as a part of dividend. Still, you are retaining some of the amount. That is, it may retain as a part of the profit, and it can be utilized as a capital for the further long-term activities of your company. Then, so retained earnings, that the earnings which you have kept separately from the part of your profits, that is called a retained earning, and that is your internal financing, that is long-term finance. Then we call depreciation fund, the fund we are generating to purchase that particular asset which will be depreciated after a long time period. We start generating fund for our fixed assets, right? So this fund is set up by a company to provide money to buy the new fixed assets. So every year the fund invests as the amount of money that is equal to the existing asset depreciation, so that when in near future, when we are going to buy new assets, then we should have some kind of fund with us that has been generated specially to purchase the new assets. So that is called depreciation fund. That fund generation is also for the long term, so it comes under the internal financing. Then term loans from the banks, that sources of finance, that is loan financing, that for some time period like for 3 to 5 years, for the expansion of the business, for the purchase of fixed assets, when we are taking loans from the banks, that is from commercial banks or development banks or cooperative banks for more than the period of 3 to 5 years, that is called term loan from banks. And this is also one of the long-term finance sources under the loan financing. Then loan from financial institutions, that are specially generated for the finance generations of your company. That can be also the source of the finance, that all those institutions that are established by central and state government, which give long-term loans at a reasonable rates of interest. So for the long-term capital investments by the company. Then now we'll be moving with next term, that is short-term business finances. That means all those finance meds that we need to meet our day-to-day expenses, that is required for the smooth running of a business. So it is known as working capital finance, that it enables continuously availability of liquid cash in your company so that the smooth running of the business can be done. The purpose of short-term business finance is to purchase raw materials that is also required for the day-to-day expenses and day-to-day working, smooth running of your business, paying the wages to the workers, payments of water and electricity. So these are all the some of the works or the expenses which we need to spend day to day. So sources of short-term finances or bank finance that can be Commercial banks grant short-term finances to the business, which is known as bank credit. Bank give credits to you. There are cash credit facilities given to the borrowers by banks, that with the specified limit. Bank overdraft, bank give you overdraft facility to their account holders to withdraw money excess of the balance in their account up to a specified limit. So overdraft facility can be arranged, that can be treated as your short-term finance. Then discounting of the bills, the of exchange, that deducting some of the amount by the banks and they are paying the you, as that is discounting of the bills. Short-term loans can be taken, that is the period, that is usually like a very small time period for the specified period of the bank loan. So these are some of the short-term finances that we can have arrangement for our business. So this is one of the source of the finance. Then some other sources are also available, that is trade credit. Trade credit refers to the credit granted to the manufacturers and traders by the suppliers of the raw material. Generally, when we purchase something from someone and they give us credit for 2 months, or suppose it for 3 months, that we'll be paying after 3 months. So that 3 months credit which has been offered by, to the manufacturer and traders by the supplier, that also work as a short-term finance for our company. Sometimes customers advances given for particular product, that can also be treated as a short-term finance that has been generated, and delivery for the goods we are going to give after some time. So these kind of credits are also short-term finances. Then we call it as installment credit. So only small amount is being paid at the time of the delivery of any of the goods, and balance is paid in the number of installments as we are purchasing our household goods. Take an example, that LCD, refrigerator, we are purchasing on installment basis, or cars we are purchasing on that installment basis for our personal use. The same way, when we are purchasing the goods for our professional use, for our business, and we are taking those goods on installment, so that is also one of the source of finance that has been generated as per installment credit. So these were the traditional sources of finance, like long-term sources of finance and short-term sources of finance. And we have discussed about these particular formats, like equity share, preference, debentures, public deposit, and in internal financing, we have gone through retained earnings, depreciation fund, and from the long-term loan from the banks, we have discussed about loan from financial institutions. And if we were talking about short-term finances, then source of finance from bank, that is cash credit, bank overdraft, bill discounting, short-term loans. Other sources are trade credit, customers advances, and installment credit. So this is one big question that can be there in your exams for BCom second year financial management students, that they can go through this lecture with that what to write in the sources of finances. Now, when we are talking about traditional sources of finance, then we must also know about the modern sources of finances. Now, in modern days, so many changes are there. Startups, established business, they need some sources of finance. For starting up of new business, we need some sources of finance. So these are three types: that angel investment, venture capital, and private equity. So let us have a look on these modern sources of finances. Then it is angel investment. This is the new term that has been introduced, that this is an experienced angel investor is an experienced industry person who provide needed fund on your idea, that is for small startup or entrepreneurs. So apart from the funds, angel invest their time, their experience, their network, and their energy in the business they invest in. So they are basically investing on your ideas. You can go through any of the examples, that how the renowned personality they are generating, they are taking the ideas, and they are the experienced industry persons, and they are investing in different new startups. They are joining with the startups like Oyo Rooms. We can see this. So these are the angel investments. That is one of the modern technique that has been followed. Then venture capital. So venture capital is the money provided to seed early stage, that is emerging growth of the companies, venture capital is the simple normal invest that funds investments in a company in exchange for the equities of the company they invest in. So which usually have a novel technology or business model in high technology industries such as biotechnology prevailing these days. So venture capital actually is the seed money provided at the early starting age of the company so that for the growth of the company. Okay, so venture capital, that Food Panda is funded by a venture capital firm, that is Rocket Internet. So there are a number of examples for the venture capital. Then private equity, that private equity consists of the investors and funds that make investments directly into the private companies, right? So or conduct buyouts of the public companies that result in delisting of a public equity. So so capital for the private equity is raised from the retail and institutional investors and can be used to fund the new technology. So basically, the scheme of modern equity or modern capital investments that goes with angel investments, venture capital, and private equity. And these are the sources of finances which in modern days, nowadays, when we need finances to start up our business, that has been taken care of. So this is all about this particular topic. So I hope you like this topic, and this will help you to understand the chapter sources of finances. Thank you so much.